I'm Daryl Kryst, Vice President of Asia Agriculture here at StoneX. You are listening to our latest installment of our AgriAsia podcast in Singapore, where we are joined by our local experts to discuss the latest market developments from an Asia perspective. Darren is away this week, so today I will be sitting down with Dixon Poe, our Vice President of Asia Agriculture, to discuss the movements in the sugar market, how the Asian crop is developing and its demand, as well as ethanol policies in the region and its impact on sugar. Let's begin. So Dixon, let's start with the big picture. What happened to sugar prices this week?
Hi Daryl, thanks for having me. So we saw raw sugar futures drop steadily throughout last week, with the October contract actually falling to a 2-month low of about 15.55 cents per pound. That's actually more than a 6% drop from where we were trading to start the week. This could have been due to a couple of things. Mainly, I think it's due to a mix of strong global supply, some weak macro sentiment, and also fund-driven pressure. On the refined side, however, we saw white sugar also pulling back. The December futures dropped from over $500 to about $478 per ton. There was some early week support from Asian demand, but that faded as we got closer to the end of the week, and refining margins also started to soften. Still, the white premium held above about $90 a ton, which is probably showing some resilience in physical demand, especially coming from this region.
I see. So leading on from that, what's going on with the speculative traders and the commercials in this market?
Well, it was a big week in the positioning data. Funds added nearly 10,000 contracts to their net short positions, bringing them to the most bearish stance that we have seen in recent months. That shows some real conviction that prices could go lower. However, on the flip side, commercial traders, being the producers and merchants, actually added over 21,000 contracts to their net longs. That's a pretty big shift, and it could suggest that some origin players or buyers may actually be seeing value at these levels. In short, funds are betting on the weakness, but the physical side of the market is starting to quietly buy the dip. Okay,
interesting. So how significant is the divergence between commercial and speculative position right now then?
So as mentioned, we saw managed money increasing their net shorts by about 10,000 contracts. But on the other hand, we saw the producer or merchant net longs jumping by over 21,000 contracts. That's actually a pretty rare and sharp divergence. So it actually suggests that funds are sort of leaning more aggressively bearish, while commercials, on the other hand, who are actually closer to the physical flows, they are starting to accumulate their longs. Historically, when positioning reaches this kind of extremes, the market tends to become more vulnerable to shock-covering rallies, especially if weather or demand surprises emerge.
Okay, so following on from that, what are traders looking out for on the technical side?
Well, technically, it still feels that the market is still under a little bit of pressure, but holding on to key levels. We kind of see support sitting around the 1550 cents mark. And if that breaks, that could possibly cause the market to come off to somewhere around the 1530 mark. However, on the upside, it feels like resistance is building around the 1580 to 1590 place, with a higher ceiling up around 1610 to 1630. But as of right now, the market feels kind of stuck, maybe to slightly bearish. And unless something big changes like weather or surprise in demand, we might just continue to grind sideways or trend slightly lower.
Okay, thanks for that. Well, we can't talk sugar without talking Brazil. Are they still flooding the market with supply?
Yes, and then some. So in the first half of August, Brazil's Center-South region increased sugar output by about 16% year-on-year. Mills are also still diverting about half of the cane to sugar rather than ethanol, since ethanol prices still look kind of unattractive. But the real question is sustainability. The weather outlook right now is dry, and cane quality, which is measured by the TRS, it's below normal. So while output is strong now, there's some growing concern about how long that can last, especially if dry conditions persist into late September.
Okay, so moving on from Brazil, what are the implications of India's ethanol policy change for global sugar flows?
So welcome to the Southeast Asia side of things. India's decision to allow unrestricted ethanol production from all cane derivatives starting in the year 25-26 adds a new layer of flexibility for mills. If ethanol prices improve, more cane could shift away from sugar, especially in years of surplus. Taking account the global perspective, this means that India could potentially swing more sharply between being a net exporter and a tight domestic market. It's a medium-term wildcard and will be heavily influenced by other factors such as crude oil prices, ethanol demand, and domestic support policies.
Great. So we will be keeping an eye out for that then. So moving to Asia, what are Asian crops looking like and how is demand shaping out?
So it's generally a good story in Asia. India and Thailand's king crops are looking to be in pretty good shape thanks to strong rains. So this could potentially mean plenty of supply heading into the 2025 and 26 cycle. Meanwhile, India's new ethanol policy will also allow mills to divert cane more flexibly starting next year. If ethanol prices rise, it could potentially mean less sugar down the line. On the demand side, Pakistan continued to be active, issuing a new tender for about 100,000 metric tons after already purchasing 30,000 metric tons earlier in the week. So these tenders are helping support the white sugar market, especially for Asian refiners.
Okay, thanks. So let's round this off with what's the takeaway for traders in Asia this week?
Yeah, so I would say that this is the bottom line. We've got plenty of supply coming from Brazil, good crop prospects in Asia, and funds that are heavily short. These are all factors that are keeping pressure on the market. But commercials are also buying more, and weather is sort of turning into a wildcard. For traders and buyers in Asia, the message is this: watch for any supply hiccups or fresh buying tenders. They could quickly flip the tone of the market, especially if speculative shorts get caught offside. Until then, sugar looks to be stuck in a supply-heavy cycle, but cracks are also starting to show. Something to note as well, the October-March raw sugar spread has remained in mild contango, which means that forward prices are actually trading higher than spot. So this usually reflects comfortable near-term supply and a lack of urgency from end users. In short, traders aren't scrambling for nearby sugar, suggesting that supply chains, at least for the third quarter, are pretty well covered. Now, if this spread were to flip into backwardation, it could indicate tightening supply or stronger demand for immediate delivery.
Perfect. Thanks, Dixon. Thank you for your valuable insight. And thank you for showing us what we should be looking out for in the near term. So that's it for the podcast this week. Thank you all for tuning in. And please don't forget to like and subscribe and keep on following as we progress through the weeks. All the best. Bye-bye.
This podcast is for informational purposes only and is not a recommendation to trade, an investment research, or an offer to buy or sell any financial product. It does not take into account your particular investment objectives, financial situation, or needs. The trading of financial products such as futures, options, or swaps involves a substantial amount of risk and may not be suitable for everyone. Past results are not indicative of future performance. You are advised to perform an independent investigation of any transaction to determine whether any transaction is suitable for you.